Beijing just torched $1 billion in U.S. private equity on purpose. At the same time, it's slashing Treasury holdings, stockpiling gold, and pulling capital into Hong Kong so fast, the central bank spent over $9 billion in 1 week just to defend its currency peg. Investors are fleeing the dollar, U.S. GDP just contracted, and private equity markets are seizing up. This isn't a market correction, it's a financial rejection. So the question is, what happens if China never comes back? Reuters confirmed that China Investment Corporation, which manages $1.33 trillion in assets, began offloading $1 billion worth of U.S. private equity holdings, assets tied to firms like Blackstone and Carlyle. These aren't legacy sales. They're strategic exits mid-cycle, with U.S. bank Evercore tapped to manage the divestment. The timing aligns with Beijing's explicit 2025 directive discouraging outbound investment into politically sensitive markets, especially U.S. sectors under growing scrutiny. But here's what makes this move explosive. CIC isn't waiting for these high-risk assets to mature. It's liquidating now, even as valuations are down 22% across U.S. PE since 2021, according to PitchBook. Why the urgency? Because Beijing appears willing to accept reduced returns in exchange for insulation from geopolitical seizure, forced asset sales, or regulatory blockage. What comes next may not just affect China's exposure, it could drag private U.S. markets into a sustained liquidity crunch. According to Bloomberg, China has quietly reduced its holdings of U.S. Treasuries from over $1.07 trillion in 2018 to $775 billion by March 2025. But this isn't just a shift in volume. It's a redirection of capital strategy. The Financial Times reports that state-backed funds have halted new investments in U.S. tech, energy, and biotech, citing national security roadblocks from the Committee on Foreign Investment in the United States. Meanwhile, China has ramped up its allocation to euro-denominated bonds and is now the largest foreign holder of German bunds, based on Q1 2025 disclosures from Deutsche Bundesbank. In tandem, Beijing's state media has amplified its dual circulation doctrine, favoring domestic self-sufficiency while overseas capital flows are rerouted toward belt and road-aligned economies. If this relocation accelerates, the net result could be a global redistribution of capital away from Wall Street and toward alternative hubs that don't carry the political baggage of U.S. jurisdiction. But capital doesn't just vanish. So where exactly is it consolidating? In the first 4 months of 2025, the People's Bank of China purchased nearly 30 tons of gold, its sixth consecutive monthly acquisition streak, pushing total reserves to 2,330 tons. Goldman Sachs now estimates that gold makes up just over 8% of China's total foreign exchange reserves, well below the global central bank average of 20%, but rising fast. Ross Norman, CEO of Metals Daily, notes that the steady accumulation pattern suggests strategic reallocation, not opportunism. Unlike U.S. Treasuries, which carry currency and sanction risk, gold offers China an unencumbered asset with no counterparty exposure. And the timing isn't subtle. Since the U.S. froze $300 billion of Russian reserves in 2022, gold purchases by central banks worldwide have surged fivefold, according to the World Gold Council. Beijing's approach isn't to shock the market, it's to shift momentum. If this pace holds, China could cross 10% gold allocation by Q1 2026, structurally weakening the dollar's global grip. But what if the signs of this pivot are already showing up? In places most analysts aren't even looking. U.S. officials framed the latest tariff wave as a negotiation tool, not a trigger for systemic stress. Yet according to the Bureau of Economic Analysis, first quarter 2025 GDP shrank 0.3%, the first contraction since the pandemic recovery. Simultaneously, the U.S. dollar index dropped 4.5% in April, its worst monthly slide since 2022. Treasury yields spiked, not because of growth, but because buyers vanished. Japan, the largest non-China foreign holder of U.S. debt, reduced its holdings by $37 billion this quarter, prompting Moody's to issue a watch for long-term U.S. credit downgrades if deficit financing continues unchecked. Meanwhile, PIMCO's Dan Ivison told the Financial Times that recession risks are at their highest levels in years, warning of stagflation if tariffs collide with tight credit conditions. This wasn't the intended outcome. But as gold surges, private investment retreats, and America's allies question its fiscal sustainability, the next fault line may not be economic. It might be structural. On May 3rd, Bloomberg reported that the Hong Kong Monetary Authority intervened with 73.3 billion Hong Kong dollars, or 9.4 billion US dollars, in currency markets, its largest single-day operation since 2020. But here's the twist. They weren't propping up the HKD, they were weakening it. The peg to the US dollar was too strong. Surging demand for Hong Kong dollars, driven by record capital inflows into Chinese tech IPOs, like CATL's $8.1 billion offering, had pushed the currency to the top of its trading band. Investors weren't fleeing to dollars, they were leaving them. The HKD peg, established in 1983, was originally meant to stabilize Hong Kong amid geopolitical uncertainty. Today, it's becoming a proxy for Beijing's capital pull, driven by equity inflows, dividend conversions, and carry trade demand. Citigroup strategist Adrian Louis now expects continued HKMA interventions on the strong side as long as dollar weakness persists. If the HKD continues to attract capital even amid U.S. tightening, it could signal that global investors are pricing in not just dollar volatility but dollar retreat. Despite sharp rhetoric from U.S. officials like Peter Navarro, who in the Telegraph accused Britain of being a compliant servant of communist China, London is resisting American demands to sever ties with Beijing. Chancellor Rachel Reeves publicly warned that disengaging from the world's second-largest economy would be foolish, especially as the UK faces stagnant productivity and widening trade deficits. According to the Office for National Statistics, China accounted for £68.7 billion in UK trade in 2024, nearly 7% of total goods movement, critical for sectors like electric vehicles and pharmaceuticals. The UK is also pursuing Chinese investment, including a potential Shine IPO in London, signaling divergence from US decoupling strategy. A leaked cabinet briefing reported by The Guardian showed internal resistance to Washington's tariff-based coercion, with one senior advisor calling U.S. demands economically self-destructive. While Washington escalates, Britain is calculating, quietly pivoting toward resilience, not alignment. Peter Navarro's April speech claimed, "If the Chinese vampire can't suck the American blood, it's going to suck the UK dry," but that narrative is unraveling under scrutiny. China's outbound foreign direct investment into the UK dropped 27% year-over-year in 2024, according to Rhodium Group, not expanded. British regulators have also blocked Chinese involvement in nuclear and telecom infrastructure, including Huawei's exclusion from 5G, a move led by MI5's security advisory. Navarro's framing ignores these facts, instead pushing ideological alignment at the cost of strategic nuance. The UK has taken calculated steps, not capitulation, says Fiona Hill, former US National Security Council advisor. The danger lies in mistaking inflammatory analogies for policy. London sees trade as a negotiation table, not a battlefield, and it's betting that moderation, not maximum pressure, is the currency that holds value. With both economies under pressure, the trade war is no longer about leverage, it's about optics. Trump, facing a first quarter 2025 GDP contraction of 0.3% and a 1.1% decline in real wages, is scrambling to frame tariffs as victory, despite soaring import costs. Xi, meanwhile, is juggling 5.3% youth unemployment and a property sector that saw a 22% year-over-year drop in housing starts, according to China's National Bureau of Statistics. This is now a two-level game, says Dr. Wen Tai-sung of the Australian Centre on China in the World. Both leaders are managing foreign brinkmanship while signaling control at home. Trump's narrative centers on reclaiming industrial might. Xi's narrative focuses on resilience and multipolar strength. Neither leader can afford to blink first, because behind every customs declaration is a political campaign ad. And as domestic pressure builds, so does the risk of policy distortion overtaking economic logic. Publicly, both Washington and Beijing claim they're ready to talk. Privately, neither wants to be the first to move. The Chinese Ministry of Commerce said it's assessing negotiations, while U.S. Treasury officials insist the door is open. But that ambiguity is strategic. A Weibo account tied to China Central Television stated bluntly, the U.S. must be the more anxious party. Meanwhile, Treasury Secretary Scott Bessent told IIF delegates there's a real opportunity for a big deal, if China's serious. This vague posturing reflects a diplomatic tactic known as constructive ambiguity, used historically in U.S.-Soviet arms talks, and now repurposed for economic warfare. It's about preserving face while probing for compromise, says Jia Ian Chong of the National University of Singapore. The world sees two superpowers stalled. But underneath the silence, positioning continues, and the first to speak risks losing the narrative war. As of late April 2025, CFTC data shows $17.2 billion in active net short positions against the US dollar, up from $9.8 billion in January, driven by weakening fundamentals, not speculation. Bloomberg's dollar index has slipped nearly 10% year to date, dragged by trade imbalances, policy uncertainty, and collapsing import flows. Meanwhile, the yield spread between 10-year U.S. Treasuries and Chinese government bonds has narrowed to just 32 basis points, its tightest margin since 2006, reducing the incentive for global capital to favor U.S. assets. This isn't just about trade anymore, said Morgan Stanley's Ruchir Sharma. The dollar is becoming the casualty of U.S. industrial unpreparedness. China, in contrast, is managing a gradual yuan float while executing a 1.5 trillion yuan stimulus without triggering capital flight. The very financial system that once protected U.S. dominance is now enabling a reversal. If the dollar keeps slipping, Beijing may not need to retaliate at all. It can just wait. The trade war is no longer bilateral. It's cascading into multilateral realignment. According to WTO data, China's exports to the BRICS bloc rose 19.4% year-over-year in Q1 2025, while exports to the US fell 31.7%. Simultaneously, the EU's internal trade increased by 12%, driven by strategic stockpiling and alternative sourcing. In the middle, the UK is negotiating parallel deals, one with Trump's White House, which insists on lower, non-tariff barriers for U.S. agriculture, and one with Brussels, aiming to preserve frictionless EU trade. This is the stress test for globalization 2.0, said Adam Tooze, Columbia historian and author of Shutdown. If countries are forced to choose between dollar-centric security and yuan-enabled affordability, alliances could fracture. What emerges may not be a new bloc, but a tangled web of economic loyalties shaped less by ideology than inflation rates, labor costs, and shipping lanes. The world isn't decoupling, it's repricing. So let me ask you, who's really shaping the future of trade, governments, or investors? Is this just a phase in a larger standoff? Or are we watching the birth of a new world order without a single center of gravity? Drop your thoughts in the comments. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.